All right, let's talk about something that sounds, well, frankly, it sounds like a headline from a satire website. We're going to connect a political squabble over Greenland to the global silver market. And I know that sounds strange, but the shockwaves are very, very real. And they could be telling us that the whole system for this multi-billion-dollar market is about to change in a big way.
And no, this is not satire. You've got a market that moves hundreds of billions of dollars, and it's facing a massive disruption. It's not because a mine collapsed or a major refinery had an accident. Nope, it's because of a political demand for a giant frozen island. If that doesn't tell you how fragile this whole financial structure is, I don't know what will.
So here's the big question we're going to unravel in this explainer. How can something that sounds like a late-night talk show punchline threaten to basically rip the plumbing out from under the entire Western silver market? Let's figure it out.
Okay, first things first, let's look at the event itself. Because while most people are reading the headlines and maybe having a little chuckle about it all, you can bet that behind the closed doors of the precious metals world, the mood is anything but funny. It is pure panic.
See, buried deep inside all this political drama is one little sentence that's throwing everything into chaos. It's a proposed 10% tariff on a bunch of European imports. And here's the kicker. That list of countries includes the United Kingdom. Now, to you and me, that just sounds like more political noise. But if you're a risk manager at a big bank, that sentence might as well be the warning label on a ticking bomb.
And look, this isn't some problem for way down the road. The tariff is slated to kick in on February 1st, and it could jump to a mind-boggling 25% by June 1st. You have to remember, markets don't wait for things to happen. They react to the threat of them happening. The damage? Well, it's already starting.
So to really get why this is so incredibly dangerous, we first need to pull back the curtain and understand how the global silver market is supposed to operate. It's this huge, complicated machine, but it really runs on one very simple and, as we're about to see, very fragile assumption.
Think of the Western market as basically having two giant pillars holding it up. Over in London, you have the LBMA. That's the world's vault for the big, physical wholesale silver bars. We're talking the heavy stuff. Then you've got New York, the COMEX. That's the world center for paper contracts, the place where the futures price of silver is set. They're two different cities, two different jobs, but they are absolutely supposed to be two sides of the same coin. Now, the magic trick that holds this whole thing together is a concept called fungibility. It's just a fancy word, but the idea is simple. The system works by pretending that an ounce of silver sitting in a London vault is exactly the same and perfectly interchangeable with an ounce of silver in a New York vault. Location isn't supposed to matter. But here's the secret. In the real world, location always matters.
For decades, the big banks have kept this illusion going with a system that's a lot like that arcade game Whack-A-Mole. A mole of demand pops up in New York. Whack! They rush physical bars over from London to smack it down. Things get a little tight on supply in London. Whack! They pull bars from New York and ship them across the Atlantic. It's this constant juggling act, back and forth, that keeps the price stable and makes everything look fine from the outside.
But what happens when someone comes along and builds a giant wall right in the middle of that juggling act? Well, you're about to find out, because that is precisely what this Greenland tariff does. You see, a 10% tariff isn't just a fee, it's an executioner. Think about it. If a bank in the US ships silver over to London to help them out, it now faces a crippling 10% penalty just to bring that metal back home later. It totally destroys the economic reason for moving metal back and forth. The game is over.
This situation creates what the source material brilliantly calls a roach motel effect for all the physical silver that's already sitting inside the United States.
Think about it like this. Once physical silver is inside the US, that tariff makes it so expensive to ship it out to help London and then ship it back again. It's just not worth it. So the metal gets stuck. It checks in, but it doesn't check out. And just like that, the whack-a-mole system that the entire market was built on is broken. And by the way, if you're finding this explanation helpful, please take a quick moment to like, share, and subscribe. That way you won't miss any of our future updates as this situation unfolds. So what happens when you trap the metal and you shatter the link between the two biggest silver markets on the planet? Well, the consequences aren't theoretical. They're immediate, and they are severe. All of a sudden, London, which has already been bleeding physical silver to buyers in the East for years, loses its emergency backup supply from New York. It's effectively a besieged city, totally cut off and under incredible pressure. And this is where the market really starts to crack. The second the traders figure out metal can't just flow freely to close the price gap, you don't have one global silver price anymore. You have two. You could see silver trading at one price in New York and a much, much higher price in London, all because London simply cannot get its hands on enough physical metal to meet its delivery promises. And that sets off this terrifying chain reaction, a real domino effect. The arbitrage game, profiting from those price differences, is dead. The super complex hedging models the banks rely on to protect themselves, they fail. Confidence just evaporates. People start hoarding because the metal is trapped. And what started as a simple shipping and logistics problem, a liquidity problem, is now in danger of becoming a much, much scarier solvency problem, where major players just can't pay what they owe.
Okay. That's a lot of high-level market mechanics. Let's bring this all the way down to earth. What does a structural crisis in the wholesale silver market actually mean for you personally?
Here is the absolute key point to understand. The next time you see the price to buy a physical silver coin or bar, what we call the premium, and it's way higher than the spot price you see on TV, it is not just dealer greed. It's the real world screaming at you that the screen price is missing the story. That premium is pricing in the very real risks and the logistical nightmare that this tariff has unleashed.
A really good way to picture this is to think of the market in 3 layers. At the top, you have layer 1, the paper price on your screen. It's going to try to pretend nothing is wrong for as long as it possibly can. Then there's layer 2, the wholesale market. That's where the tariff is doing the direct damage. And finally, you have layer 3, the retail market, the coins and bars you can actually hold. That's where you and I feel the stress from layer 2 in the form of higher prices and tighter supplies.
So, what do we take away from all this? Well, 3 things. First, in a world where borders are becoming barriers again, the safest place for your physical metal is probably wherever you are. Second, it's time to stop looking only at that spot price and start thinking in terms of the real all-in replacement cost. And third, buckle up and expect volatility. Big price swings are often used to scare people and shake them out of their holdings, sometimes right before a big move happens.
And all of this leaves us with one final and I think absolutely critical question. The entire modern pricing system for Western precious metals was built on one single assumption, that metal could move freely around the world, anytime, anywhere, forever. Now, a simple political decision has shown that assumption to be false. So what happens to the value of all those paper promises that were built on a foundation that just crumbled?